If you had $50,000 today, what would you do to turn it into a substantial amount of wealth over the next 20 years? Would you buy a rental property or invest it in a long-term investment fund? Millions of Americans have chosen one of these two paths, and most of them believe their choice is the better one. But when you put both strategies into the same spreadsheet and account for everything, returns, expenses, time, risk, and the factors that are often overlooked, a different picture begins to emerge. Most people focus on how much money they could make. Very few stop to calculate the price they have to pay to make that money. And that single detail can completely change the outcome. Meet Jake and Marcus. Both are 35 years old, earn about $90,000 a year, and have $50,000 in savings. They live in the same city, start from the same financial position, and share the same goal: to build as much wealth as possible over the next 20 years. Jake decides to use his entire $50,000 as a 20% down payment on a $250,000 rental property. He finances the remaining $200,000 with a 20-year fixed-rate mortgage at 7% interest. His monthly principal and interest payment comes to about $1,550. Jake believes that a combination of rental income and long-term property appreciation will help him build significant wealth over time. Marcus takes a completely different approach. He invests the entire $50,000 into a long-term investment fund and sets up an automatic contribution of $300 per month, or $3,600 per year. No leverage, no tenants, no six-figure loan hanging over his head. Two people, the same starting capital, the same income, the same 20-year time horizon. The only difference is where they choose to put their money. Right from the first year, Jake feels like he's winning. He owns a $250,000 rental property. Each month, his tenant pays about $2,070 in rent. After making his mortgage payment of roughly $1,550, Jake is left with nearly $520 per month in positive cash flow. On paper, that's more than $6,000 a year. Jake loves that feeling. Every month, money shows up in his bank account. Friends ask him about his rental property. Family members tell him he's making a smart investment. Some of his coworkers even say that real estate is how wealthy families build generational wealth. And honestly, it all sounds pretty convincing. Jake owns a real asset he can see and touch. He has a tenant helping pay down his mortgage. And he knows that if home prices continue to rise over time, the value of his property will rise with them. Everything feels tangible, predictable, like a wealth-building plan that's actually working. If the story ended here, most people would probably choose Jake's path without thinking twice. Marcus, on the other hand, has a completely different experience. He doesn't have a property to show off to his friends. He doesn't have tenants sending money to his bank account every month. He doesn't carry a set of keys in his pocket or own an asset he can drive past and proudly say, "I own that." Instead, Marcus invests his $50,000 into a long-term investment fund and contributes an additional $300 every month. He expects his portfolio to generate an average annual return of around 10% over the long run. But that's only an expectation, not something that happens consistently year after year. Some months, his account gains a few $100s. Other months, a market downturn wipes out those gains in a matter of days. Sometimes Marcus logs in and sees his portfolio higher than it was the month before. Other times, he sees red numbers and temporary losses staring back at him on the screen. Everything feels slow and honestly a little boring. Nobody asks Marcus what he's investing in. Nobody seems particularly impressed when he mentions an investment fund. And if he's being honest with himself, there are times when he wonders whether he's missing out on a better opportunity. While Jake sees rent payments arriving every month and watches a physical property grow in value, Marcus is simply watching numbers move up and down on a screen. In the early years, that difference makes investing in a fund feel far less exciting, even though the long-term outcome may tell a very different story. For the first 2 or 3 years, things go pretty smoothly for Jake. The rent checks keep arriving every month, and the property continues to rise in value. But then, the expenses that most people tend to ignore start showing up. Every year, Jake has to pay property taxes and homeowners insurance. Occasionally, the property sits vacant between tenants, which means the mortgage still has to be paid even though no rent is coming in. Then there are the regular maintenance costs. A common rule of thumb among real estate investors is to set aside about 1% of a property's value each year for maintenance. For Jake's $250,000 rental property, that's roughly $2,500 annually. Some years, it's nothing more than fixing a leaky faucet or replacing a small appliance. Other years, unexpected repairs cost several $1,000s. As time goes on, larger expenses begin to appear, replacing a water heater, repairing plumbing issues, or servicing the HVAC system. And eventually, like every homeowner, Jake will face major capital expenses, such as a new roof or a full HVAC replacement, projects that can cost thousands or even tens of thousands of dollars. But there's another cost that's much harder to see on a bank statement: time. A few hours each week spent responding to tenant messages, coordinating property repairs, getting contractor estimates, or checking on the property may not sound like much. But over the course of many years, those hours add up. What initially looked like passive income starts to feel a lot more like running a small business. The property is still generating income. It's still building equity. But by now, Jake is starting to realize that those monthly cash flow numbers don't tell the whole story.
5 years into the journey, Jake has plenty of reasons to believe he made the right choice. The property he purchased for $250,000 is now worth roughly $304,000, assuming home prices have appreciated at an average rate of 4% per year. During that time, his tenants have also been helping pay down the mortgage. What started as a $200,000 loan has been reduced to approximately $173,000. As a result, Jake now has about $131,000 in equity tied up in the property. That includes his original down payment, the principal that has been paid off over time, and the appreciation of the home itself. On paper, those numbers look impressive, but they don't tell the whole story. Over the past 5 years, Jake has continued paying property taxes, insurance, maintenance costs, and occasional repair bills. Using the common rule of thumb of setting aside 1% of a property's value each year for maintenance, that's roughly $12,500 over 5 years alone. The property hasn't been occupied every single month either. During tenant turnover, Jake experienced about 2 months of vacancy, which meant the mortgage still had to be paid even though no rent was coming in. There were also cleaning costs, minor repairs, and expenses associated with finding new tenants. That original $520 per month of cash flow looked great at first. But once all the real-world expenses are included, a significant portion of that cash flow gradually disappears. Meanwhile, Marcus has done exactly one thing. He kept investing. Every month, another $300 goes into his investment fund. No tenants, no maintenance calls, no unexpected repair bills. After 5 years, Marcus has contributed a total of $68,000, including his original $50,000 investment. However, the market hasn't delivered the 10% annual returns that many investors hope for.
Assuming an average return closer to 7% per year during this period, his portfolio has grown to approximately $89,000. He's making progress, but it doesn't feel nearly as exciting as what Jake is experiencing. If the comparison ended here, most people would probably choose real estate. Jake appears to own a property worth more than $300,000 and has built over $130,000 in equity. Marcus has an investment account worth less than $90,000. From the outside, the winner seems obvious. And that's exactly why so many people become convinced they already know the outcome long before the story is over. 10 years into the journey, the picture starts becoming much clearer. Assuming home prices have appreciated at an average rate of 4% per year, Jake's $250,000 rental property is now worth roughly $370,000. Over the same period, his original $200,000 mortgage balance has been reduced to approximately $110,000. On paper, Jake now has about $260,000 in equity tied up in the property. That's a significant amount of wealth. But once again, equity doesn't tell the entire story. Over the past decade, Jake has continued paying property taxes, insurance, maintenance costs, vacancy expenses, and a steady stream of repairs. Setting aside roughly 1% of the property's value each year for maintenance alone has cost tens of thousands of dollars over 10 years. As the property ages, larger expenses also begin moving closer to reality. Major systems such as the roof, HVAC unit, water heater, and other critical components are approaching the point where replacement or major upgrades may be necessary. These aren't unusual expenses. They're simply part of owning real estate for the long term. Meanwhile, Marcus has stayed with the same strategy from day one.
After 10 years, he has invested a total of $86,000, including his original $50,000 investment and $36,000 in monthly contributions. Assuming an average annual return of roughly 8%, his portfolio has grown to approximately $150,000. At first glance, Jake still appears to be well ahead. About $260,000 in equity versus roughly $150,000 in an investment account is a meaningful difference. But something important is beginning to change. For the first time, a growing portion of Marcus's portfolio isn't coming from the money he's adding each month. It's coming from the returns generated by the portfolio itself. His investments are starting to produce more growth than his annual contributions. And that's the moment when compounding begins to shift from theory into reality. Jake's wealth is still growing, but it continues to depend on managing a property, controlling expenses, and maintaining a valuable asset. Marcus's wealth is growing for a different reason. The money is beginning to do more of the work on its own. And while Jake still appears to be leading the race, this is the point where the gap stops widening and starts getting smaller.
By year 15, this comparison is no longer just about money. It's becoming a story about lifestyle. Assuming home prices continue to appreciate at an average rate of 4% per year, Jake's rental property is now worth nearly $450,000. His mortgage balance has been reduced to roughly $56,000, leaving him with close to $394,000 in equity. On paper, Jake has built an impressive amount of wealth. Meanwhile, Marcus has contributed a total of about $104,000 over the past 15 years, including his original investment and monthly contributions. Thanks to the power of compounding and a stronger market environment over the last several years, his investment fund has grown to approximately $280,000. Jake is still ahead. But after 15 years, Jake has also learned something that doesn't show up on a spreadsheet. Owning real estate isn't as passive as many people imagine. Over the years, he's dealt with tenant turnover, contractor calls, maintenance projects, repair estimates, appliance replacements, and the endless list of responsibilities that comes with owning a property for the long term.
When the air conditioning stops working in the middle of summer, or a major system reaches the end of its life, Jake is the one making the decisions and writing the checks. Marcus's life looks remarkably similar to what it looked like 15 years ago. He doesn't manage a property. He doesn't coordinate repairs. He doesn't worry about an aging building or unexpected maintenance costs. For the most part, his job has been simple. Keep investing and let time do the heavy lifting. And that's when a different question begins to emerge. Not which investment has made more money, but what it actually took to earn that money. Jake has built more wealth, but he has also accepted more responsibility. Marcus has accumulated less wealth so far, but he has done it with far fewer demands on his time and attention. After 15 years, the gap between them is no longer growing the way it once was. And for the first time, it becomes reasonable to wonder whether the final outcome will be as different as it appears today. After 20 years, we can finally look at the results. Assuming the property appreciated at an average rate of 4% per year, Jake's $250,000 rental property is now worth approximately $548,000. His original $200,000 mortgage has been completely paid off. If Jake decides to sell the property, after accounting for selling costs and transaction fees, he could walk away with roughly $510,000 in cash. But Jake didn't create that wealth alone. For 2 decades, rental income helped cover a large portion of the mortgage payments. His tenants contributed to paying down the debt, while property appreciation steadily increased the value of the asset. In exchange, Jake accepted the responsibilities that come with being a landlord: property taxes, insurance, maintenance, repairs, vacancies, and the ongoing costs of owning an aging property. Marcus followed a much simpler path. He invested $50,000 upfront and continued contributing $300 every month for 20 years. In total, Marcus personally invested about $122,000 of his own money. Growth was slow in the beginning, but over time, compounding started doing more and more of the heavy lifting. Thanks to stronger market returns during the later years of the journey, his portfolio is now worth approximately $520,000 to $540,000. And this is where the story becomes interesting. After 20 years, the gap between the two outcomes is far smaller than most people expect when they first begin the real estate versus investment fund debate. Jake finishes with roughly $510,000 after selling the property.
Marcus finishes with an investment portfolio worth more than $500,000. One built wealth through leverage, rental income, and property ownership. The other built wealth through consistency, patience, and the power of compounding. When you look only at the final numbers, neither strategy completely dominates the other. Both created substantial wealth. Both turned $50,000 into something much larger. And both proved that building wealth is possible when you give a strategy enough time to work. Which investment made more money? In this example, the answer is surprisingly close. But the bigger lesson is that wealth is rarely created by finding a perfect investment. It's usually created by choosing a strategy you can stick with for decades. Because in the end, the investment that makes the most money isn't always the one with the highest return. It's often the one you can keep long enough to reach the finish line.
Everything we've discussed so far is based on one simple assumption. Jake and Marcus both stick to their plans for the entire 20 years. But in the real world, nobody knows exactly what the next 2 decades will look like. Jake could benefit from stronger than expected home price appreciation and end up making far more money than our projections suggest. Or he could face periods of slower growth, rising maintenance costs, higher property taxes, unexpected repairs, or extended vacancies between tenants. Marcus faces uncertainty too. The stock market doesn't move in a straight line. There will be years when his portfolio grows rapidly. There may also be years when it falls 20%, 30%, or even more. There could be long stretches where it feels like little or no progress is being made, despite continuing to invest. And that's exactly why nobody can guarantee which investment will create more wealth over the next 20 years. What we do know is that both real estate and investment funds have helped millions of people build significant wealth over the long run, but only if they stayed invested long enough for the strategy to work. More importantly, before choosing any investment, you need to understand what you're actually trying to accomplish. If your goal is to generate income and cash flow, rental real estate may offer advantages that an investment fund cannot. If your goal is long-term wealth growth with less day-to-day involvement, an investment fund may be the better fit. Because in the real world, the difference between people who achieve financial freedom and those who don't is rarely determined by whether they chose real estate or investment funds. More often, it's determined by whether they had the discipline to keep going when things became difficult. In the end, both strategies are trying to accomplish the same thing: generate more income, build more wealth, create more financial freedom. The best investment isn't always the one with the highest return on paper. It's the one that aligns with your goals
and that you can continue following for years without giving up.